All right, so this is going to be the final lesson of month 1 of the StoianCapital mentorship. And this is a lesson that has helped me understand and be secure on what I believe that the market is going to do, and use the prior information towards understanding what type of environment the market is in. So this is the algorithmic phases, which go from consolidation, expansion, retracement, and reversal. What I'm going to do first is I'm going to reinforce the smart money paradigm, which is, as stated in the previous lecture, the market does only two things. It goes up for liquidity or inefficiency, or goes lower for liquidity or inefficiency. Using said information along with the AMD, we will then need to understand in which market environment we are trading in. So are we inside of the consolidation? Do we anticipate the market to expand? Do we anticipate the market to reverse? And this goes on into the higher time frame chart. And we're going to understand within month 2 and month 3 how to use the higher time frame chart. And this also goes inside of the 1 minute or the 15-minute, which is linked to a higher time frame, which we will understand how to do in the next lectures. But again, using said information along with the AMD, we will then need to understand in which market environment we're trading in. So what are we currently doing? Because we can expect the market to go higher, but within the current time, we can anticipate the market to first consolidate, expand lower to take a form of sell side or buy side, and then go into the other direction. So we can be correct about our bias, but the way in which we approach the trade in itself can be wrong because of this exact lesson, because not understanding the environment. And we will correlate the market environment with a specific PD array we're looking for in relationship to that environment. So for instance, if I'm going to look for an expansion to the upside after the market has successfully taken a level of sell stops or buy stops, I'm going to link that expansion and I'm going to look for one specific PD array for that expansion to occur, or for that retracement to occur, or for that consolidation to occur. But first, I want you to understand what PD arrays really are. So PD stands for premium discount, which shows us where a PD array is in relationship to a specific range or the current market price. And we've discussed about premium discount in the last lecture. For example, if the market trades at a specific level and we're looking forward to a run lower into a fair value gap, that will be called a discount array, more specifically a discount fair value gap. So if the market trades higher, which can be in relationship to a dealing range, or it can be in a relationship with the time of when we're looking for the market to do a specific thing. For example, if we see the 9:30 opening price and the market is lower and we're looking forward for a discount run, we're going to look for something which is below the opening price. And if below the opening price there is going to be a discount fair value gap, then that is going to be indeed called a discount fair value gap. The array is a concept we will use, which is the following: the order block, the fair value gap, the equilibrium price point, and then the sell side and buy side liquidity pool. So PD stands for premium discount, and then the arrays are going to be order block, fair value gap, equilibrium, and sell side buy side. For each PD array, we will give a brief description to what it is, leaving the in-depth explanation to a later time in the mentorship, like we did for the fair value gap. So the first thing we're going to start off is going to be the consolidation. The purpose of the consolidation is going to be the following. The consolidation within a defined market range is used for the purpose of accumulating orders in both sides of the marketplace. So the consolidation is not without a purpose. The consolidation is for the market to have both buy side and sell side liquidity pools, to have both willing buyers and sellers inside of the market. The attributed PD array is going to be the following. the equilibrium price point, which is 50% from the high of the dealing range to the low. The consolidation is always followed by an expansion outside of the range. The market can never go consolidation retracement or consolidation reversal. When the market consolidates, we can always expect the market to expand beyond it, and then we can indeed look for whether the market is going to retrace or reverse. So it is always consolidation, expansion, and then afterwards we can decide if we want to see the market retrace or reverse. The premium discount price range. As stated in the Smart Money Paradigm lecture, as smart money traders, we are going to look for a discount price for our buying opportunities and for a premium price for our shorting opportunities. The premium, again, is everything that is above the 50% of the dealing range, and the discount is everything that is below the 50% of the dealing range. For consolidations, we're going to look at the 50% equilibrium point where the market will not move directionally, consolidating around that specific point. The consolidation plus premium discount, again, this is how it looks like. We have a defined swing high representing the dealing range high, and we have a defined swing low representing the dealing range low. The expansion. Purpose. The expansion is the phase where the market moves one directionally, attacking a liquidity pool or inefficiency. The PDA we're going to use for this expansion is going to be the order block, and the expansion is going to always follow a consolidation or a retracement. Crucial understanding, the market will only do one of these phases. We will never internalize the market retracing and expanding in the same time frame. So for instance, I can see the market retracing back into a fair value gap on a higher time frame chart. So that move will occur within weeks or even months. But that is a retracement for the monthly chart or for the weekly chart. But within our lower time frame chart, like the 15-minute or 1 hour, we will see the market expanding back into that fair value gap or whatever liquidity pool there is inside of the hourly chart. But we will never expect the market to retrace and to expand in the same time frame. And you'll see why this is very crucial. The order block inside of the expansion. A bullish order block, also known as the change in the state of delivery, is a down close candlestick that will be used as a means of supporting price higher. So we're looking at the chart, we want to see the market go higher, and therefore during an expansional run, all bullish order blocks support the price action movement higher. And this is the order block inside of the expansion. So we have the market creating a swing low, market goes higher, and then once the market goes back into the bullish order block, we can expect the market to be sent higher from that order block. The reason why, exactly as I've told you inside of the last talk about swing lows and about liquidity pools and about market structure, this order block is used by smart money to buy inside of. And everything goes in reverse when we're talking about a shorting scenario. The expansion will look like this when we're talking about a line chart or crude depiction. We have right here, we have the market expanding. The market creates a retracement, looking for a busy, knowing that we have some unfinished business above the market. And within this expansion right here, what I'm going to do is I'm going to only look for order blocks. And I'm going to tell you how we're going to use this information at the end of this presentation. But basically, this is also an expansion in which we anticipate the market to go inside of this. And then perhaps we can even standard deviate this above the specific target that we're looking for in terms of market price. And this is going to be the lesson about expansions. The retracement. The purpose of the retracement is as following. The retracement is done with the purpose of rebalancing an imbalance prior to departing higher onto our predetermined target above current market price, and of course invert for a bearish scenario. So the sole purpose of this retracement is for the market to go back into a fair value gap to make it efficient, and then we leave it. The P that we're going to use is going to be the fair value gap, and the retracement is always after an expansion and is always followed by another expansion. And again, the retracement looks like this. The market was expanding higher. Let's assume that the market took a level of sell side, and right here it took a level of buy side. So it is normal for us to expect the market to retrace. Market goes back into a busy, makes it efficient, and then we leave it, making it balanced, which is or was the sole purpose of this retracement. And now it's finished. But basically, when we're going to look for a retracement to the downside or to the upside, we're going to anticipate the market to go back into some form of a BISI or a SIBI. And the last thing we're going to talk about is going to be the reversal, which the reversal's purpose is to create a pivotal moment or movement in price where the smart money entity accumulates positions by taking an opposing liquidity pool to the one we're looking to target, then running the opposing liquidity pool prior to our target, hinting that the market has shifted from a program, X sell program, to another program, for example, a buy program. So this is the market reversal. And the reason why we're going to pair it with the liquidity pool is exactly as we stated within the last video when we talked about market structure. So when we're anticipating the market to reverse, we're going to look forward for a liquidity pool to target. The reversal is created after the market breaks away from a consolidation using an expansion. Then the market trades into the opposing pool using an expansion, which will look like this. Market consolidates. Then we break out of this range using an expansion. And then once we're trading here into some predetermined target, then if we anticipate the market to shift and we anticipate a specific target we're looking for, right? We're anticipating this to happen. If I am here, and this is a higher time frame chart, think about this. This is a higher time frame chart. If I anticipate the market to go here, which is done through understanding institutional order flow signatures and understanding next lectures we're going to talk about when we're going to talk about the specifics of order blocks, the specifics of fair value gaps, standard deviations, etc. Imagine how easy or how simple it is to determine the next likely direction, because we're here, and if we anticipate the market to reverse, then what are we going to anticipate? Well, some form of a liquidity pool to be taken, opposing to the one that we've just took. And what will happen is the market would go back into some form of a PDRA, and then throughout all of this expansion, we're going to measure, if this is a higher time frame chart, we're going to measure what the market will do until we get to this target. For instance, if we're trading here, I would anticipate the market to close above this, because I know that this is a high probability target, because this is going to be our market structure shift for the market to shift the program and to go into this target. So I will already anticipate this to be taken. This will be high probability. And if we're aiming for this, then some form of a PDRA should fail here, giving us the sign that the market is going to be indeed bullish and this is going to be taken. So when I'm here and I'm anticipating the market to reverse, my eye jumps straight to the opposing liquidity pool, and throughout this all expansion, when the market goes back into some form of an order block, that is what I anticipate the market to do. Go back into it and then repulse away from it, which gives us the first signature that we can anticipate. And this is how we internalize signatures. So we are already anticipating the market to go here based on the signatures that we've identified, which state that this is not a market structure shift. This is a liquidity pool that has been taken, and we anticipate the market, therefore, to go above this to create a market reversal. Then the market is going to go back into a retracement after we've taken this. And then if we know that the market is going to go back into a retracement, and this is for the sole purpose of the market retracing back into this BC, then we know what we're looking for. We're looking for a retracement back into a BC. So what are we targeting when we are trading here? A BC. Once the market goes here, we stop our trading. If this is some form of a higher time frame, and we're awaiting for the swing low, and then the left, the market leaving this BC, which will give us a sign that we're starting the expansion. So this is why this is very important to internalize. This is why it's very important to determine the current market environment. Because when we're trading here, and when the market trades here, and or even here, and we understand that we're trading within a consolidation, then what we're going to do is we're going to take the low to the high. 50% of this is going to be the equilibrium, and we're going to trade above it, back into it, above it again, and then we're going to wait for this expansion to break out, and eventually the reversal if we're anticipating the market to go higher. And if we were not anticipating the market to go higher, then we would anticipate the market to go back into some form of BC or CB, and then that would be a retracement after an expansion, and then the market will eventually continue to the downside towards our target. And if we anticipate the market to go back into some form of a premium CB, then we can choose to wait for this movement to occur and then trade the expansion, or we can trade the retracement back into some form of a CB. And this would be our higher time frame bias. But again, how do we use this information? By stating the current market environment based on a higher time frame chart, which is higher than our trading chart. For instance, the daily chart is the higher, the 15-minute is the lower. We will then know what period to look for and what we can expect in terms of where the market will go and how the market will deliver. For instance, if I understand that we're inside of an underlying market reversal inside of the daily chart, I will look for the bullish order block to send price higher, and when the market reaches it inside of our intraday trading, I will then look for higher prices, knowing that we should move higher towards the other higher time frame liquidity pool. So again, market goes back below this, and if I anticipate the market to go here, then inside of this range that is not materialized yet, but I'm going to want to see this range materialized, I'm going to look for specific order blocks. I will wait for the market to go back into it, which is the manipulation part of the day, imagining this is a daily time frame. And once the market goes back into the order block, then I'm going to switch to a 15-minute chart, and I'm going to wait for specific signatures that my model says that, for instance, the market goes back below previous session low. When that happens, I know that the market should reverse intraday towards our target. This was the video about algorithmic phases. This was the last video in terms of the month 1 mentorship. And for the month 2 and month 3, we will get in depth about order blocks, about narrative and bias, which is the most important thing when it comes to trading. And I will state that everything that we've stated inside of the month 1 mentorship is foundational, so it should be approached with a high degree of focus and a high degree of undivided attention. And for month 2 and month 3, I want you to use the same undivided attention, because everything that we talked about does not work without month 2 and month 3 and month 4. And everything in month 2 and month 3 and month 4 will not work without everything that we've discussed inside of month 1. So I hope you enjoyed this one, and I'll see you in the next one. Peace.